terms of what's missing to scale the energy transition, I'd say there's a number of things, but I'd probably stick with three. One is a sense of urgency. I think for society as a whole, people don't seem to recognise that we're actually losing the window of opportunity to tackle climate change. People seem to think that we've got lots of time, but that window is closing. So I think there's a need for a change in mindsets and a change in behaviour. So I think that's the urgency point. The second one is a sense about scale. I think we recognise change is needed, but we're doing it incrementally. We need the scale, and that means everybody needs to work together. We need to put aside the politics, we need to put aside the self-interest and make sure that this is actually in all of our self-interest. So I think that urgency and that scale is really important. And I think lastly is the area I'd highlight, which is a bit closer to what I do, is the role of finance and capital. Is that this cannot be financed by governments alone. You know, public finances are not going to get us there. So we need the role of private markets, the private sector, to really play its part. And that means that we have to recognise that we need to create the conditions for the private sector and the financial community to get involved in terms of creating innovative solutions that enable us all to share the risk. And I think it's a really exciting time to be in the space, and because I think what we can show as well is that it's the opportunities for the private sort of investment community to get involved goes beyond equities. Fixed income has such an important role to play. So I think those are probably the three areas I'd highlight. Asset owners are really important to finance the low carbon transition for a number of reasons. Three of them I'd say is that first of all, everybody is impacted by this, including their end beneficiaries. So they have a duty to make sure that that is addressed for them. And that duty, I think people commonly think of that they have a duty to make sure that they have the funds for their members to retire with. But actually increasingly there's a recognition that there's also an important dimension of actually, is the world they're actually going to retire into worth living? So that quality of life dimension is really important, and they have that responsibility. Secondly, they have influence. So they dictate for people like me as managers where the flows go and where the business is. So they are huge allocators of capital. So if they send that signal that this is important, it will happen. And then lastly, I guess I'd appeal to their self-interest in that whilst you can divest for certain parts of the economy to address the low carbon, they can't divest from the whole economy. Asset owners are essentially universal owners. They will be impacted by climate change in one way or the other. So it's in their self-interest to make sure that they act on this. There is such an important role of the public markets in the low carbon transition. It's something that I'm hugely passionate about. I think it's really important that private markets play a role, but we've got to remember, if we want that scale, if we want that sort of momentum and urgency, we need to bring public markets into this, because if you keep sort of supporting just at the private space, those companies will not grow to scale. We won't get the impacts that we need. So I think what public markets can give you is the larger size of AUM, the larger size of issuers that you can actually invest in, and also for us as well is that we're public debt for managers. And I think for so long people have looked at impact investing in the sort of public equities context, but the public debt market is so much bigger, and we have access to a wider set of investments and issuer types. We can actually help fund governments with this low carbon transition. You can't do that in equities. So it's such an important space to be. So I think for all of those reasons, people just have to really broaden their horizons and think about public markets and think about that in the context of impact, and we can get there. Portfolio managers can improve their sort of monitoring and portfolio management in a number of ways to address sustainability and impact. I think a key thing is actually the mindset that they have and the scope of which they're looking at what they're trying to achieve, their objectives. I think it's beyond looking at just financial measures and objectives to actually incorporate these non-financial. It's considering what is the impact you want to achieve and over what time frame. So I think the time horizon is really important. And then all of those sort of things impact actually the measures that you actually look at. And the measures you do look at, I would seriously encourage people to think about a balance of what I call sort of backward looking or current practices and current performance with future. Where is the direction of travel? Because otherwise you could be missing out on investment opportunities where it's not so impactful now, but it could be so impactful. And I think that's hugely important. I also think it's also about balancing up the measures that you look into, that they're not just sort of straightforward sort of output numerical KPIs, but they're really looking at what is the outcomes and impacts you're delivering. And I think if you take that holistic integrated approach, then I think that will end up with a more joined up approach to portfolio management.